Hi everyone, Sean Humphreys here. On March 15, 2016, we ran a great event for our clients, a lunch and learn that focused to insurance planning. The sub-theme was why risk planning is critical to financial success. We were really pleased to have Brad Charlton as one of the speakers at this session and really unpack the whole area of risk planning. Risk planning is critical. When you think about it, we're all on a financial journey. And ultimately, that financial journey is leading us to some destination point down the road. Maybe you're already living in that destination. And when we ask people what's important to them about their money, they don't say save taxes, getting better returns, doing effective income splitting. What they talk about are things like legacy and peace of mind and having financial security, helping the grandchildren. And all of those things, those aspirational goals, are predicated on the client's ability to achieve their financial objectives. Along the way are risks. And a solid wealth plan will help the client to navigate through the regular risks that people are confronted with. And that's really what risk planning is all about. Insurance planning is about offloading those natural risks. And so it's an extremely important part of overall financial planning and wealth planning. So if you're interested in trying to reduce risks and having a more effective overall wealth plan, then I know you'll really enjoy this presentation. Why risk planning is critical to financial success. What I'd like to do before we sort of get into the session today, how many of you have come to previous lunch and learns that our practice has organized? Great. Any first timers today? Okay, first timers. Okay, so we have a tradition here at the lunch and learns. If you're a first timer, if you could just stand up and just introduce yourself, give us a little bit of your bio, we'd love to hear a story. Just kidding, just kidding. Okay, now your heart's sort of calmed down a little bit. So to our guests, thanks again. We welcome you here. We hope you get some value out of our session today. Okay, what I'd like to do is, for the benefit of our guests, I think this might be a little bit helpful. Some of you, if you're not aware of who Asante is, those of your clients, hopefully you know who Asante is. But for our guests, Asante is wealth management on that far right box. We're affiliated with a company called CI Financial Corp. It's very rare these days that financial planning, wealth planning firms aren't associated with larger financial firms. It's just a reality of our business. Is about scale and size, and at the end of the day, people want to know that their advisors or practitioners are associated with firms that do have that scale and size, which often allows them to tap into expertise more effectively. And today's an example of that. So Brad is one of the ways that we can tap into that expertise, being part of a larger organization. This is old news for you, but again, for the benefit of our guests, if you're trying to figure out what Sean and his team do, as you should be, as a client, you're at the top of that, not quite a pyramid, and as an advisor, what we try to do is to give clarity and direction on your overall wealth plan. And when we look at wealth planning, that ties into areas like investment selection, asset allocation, tax planning, estate planning. There's other areas like retirement planning. And what we want to do over time is make use of experts. Brad's a good example of this. We have something called Asante Estate Insurance Planning Services, Asante Private Client Services. And so when I'm working on a client file, I can tap into those experts. Those experts are not designed to replace your existing advisors in tax planning or legal planning. They're really there to help you to make more effective use of your advisors. Because sometimes those advisors are very transaction oriented. They get busy doing the things they do, and sometimes the planning work doesn't get done. Okay, let's talk a little bit about the topic we're here to talk about today. So, insurance planning. I thought this graphic, I think I showed this graphic maybe 2 sessions ago, and I thought it was a great example of getting into our topic today. And you can see at the bottom of this graphic, see if I can get this laser working here. It goes from this continuum from income protection to asset protection. So when we talk about insurance planning, what are we getting at there? Well, when you look at your own lives, and some of you here are retired today, but before you retired, you had to earn income typically, unless you're the beneficiary of some family trust or endowment or a legacy or heir to a fortune. Most people are working for a living, at least as a couple or family or individual. And it's this income that you earn that drives all those financial assets over time that you're going to accumulate. And for many people, part of that asset accumulation might be for retirement income, financial independence, It may even be for some people legacy planning and providing for heirs or beneficiaries in the community. And so all of that legacy planning is driven off your ability to earn an income. Now in the early years, and I'm going to talk very quickly about one aspect of this, in the early years you're going to go through and carry a lot of term insurance and maybe some disability insurance and some critical illness insurance to protect your income earning power. And what I said last time, I used my family as a great example. So I have 4 children under the age of 20, and my wife, Tanya, who's taught for 15 years, made the decision to resign from her teaching position after 15 years of teaching to help raise the kids. And so if something happened to me and I die prematurely, what's the financial situation for our family if my income ceases? Pretty dire unless I have financial assets or life insurance that can replace that income if something happened to me. So a lot of us get that in the early years as we're raising our families or have financial obligations. Insurance plays a really critical role. The other aspect is around disability planning. And so there's actually a higher probability of getting a disability than premature death. And yet we take that area for granted. I mean, our ability to earn that income. And we need to have proper disability protections. Many of you over your years worked for companies or organizations that had disability programs in place. So you weren't worrying about, if I became disabled, will my income continue? Most people have some level of income continuance. The exception might be if you're self-employed. Then you need to be proactive, obviously, and get that income continuance plan in place. But what's very interesting about the area of disability planning is that people can become very cavalier in this planning in the sense that, yes, you've got disability income continuance, but are there other costs associated with disabilities than just the costs of losing income? Right? Absolutely. There's all kinds of sundry costs, additional costs that people have to look after, right, in addition to their regular monthly expenses that their income looked after previously. So it's a very important area. As we get into this chart further on, we're getting into permanent life insurance, long-term care coverages, and the issue long-term becomes more about asset protection. You know, how do we preserve assets that we've worked really, really hard to build up over time? And sometimes it's just by happenstance. You're just fortunate. I'll give you a great example. How many of you have, you don't have to put your hand up, but if you feel comfortable you can, if you have cottage property. So many of you have cottage property. So I know specifically of a few families that have cottage property in the Lake of the Woods, and they are not wealthy families. So great-granddad built that place years ago. Had a beautiful, pristine lot on the lake. But what happened to the value of that property? Successive renovations, and as years go by, where do the property values go? Stratospheric. And what's attached to the property values? Tax. So at some point, when that property is sold, there might be a large tax bill that has to be paid. Now keep in mind, these are not necessarily wealthy families. So what sometimes happens is when the last of mom and dad are gone, if there hasn't been effective planning, the actual asset that they've enjoyed so much over the years, the family has to sell to deal with the tax liability at that point. And that's why you find people, whether it's farming families that are asset rich and cash poor, or property with great emotional attachments, will have things like permanent insurance as a way of creating tax-free tax benefits at that point in time. Brad's going to talk a little bit about long-term care because another looming issue, and that's why we put together the branch event, is this issue of as I get older and as a healthcare system may go through changes with an aging demographic, how do I deal with the increasing costs of long-term care? I was talking to one of our panel members for our long-term care symposium, and she said, you know, Sean, I think it's about $45,000 of income. You're starting to pay maximum rates for long-term care in the province of Manitoba, and that ends up being, for the average family, around $30,000 a year. So if you're already living in a bungalow and you have an aging loved one that now needs long-term care, and you have to spend that money, right, to look after their care, there's obviously financial implications. So there's various ways of looking at that, and Brad will talk about that. So that's the introduction. Insurance, we have a love-hate relationship with, right? It's one of those things where we pay the premiums, not with glee. We get agitated when those property and casualty premiums come in, or life insurance premiums come in, or disability premiums come in. But when you think about it, insurance is an amazing, amazing financial instrument. When you just think about life insurance, what it does, in a heartbeat, there's a tax-free benefit that's paid to beneficiaries, could be widows or orphans or family members or business partners, that deals very simply and elegantly with sometimes are very complex financial issues. And so the history of insurance, which I was going to share with you a little bit, but I've talked on too long, is fascinating. Go to Wikipedia and just type in insurance. And you can see how the Babylonians and the sea mariners in the 1700s through Lloyd's of London and various religious organizations in the late 1700s and the early 1800s in the US created mutual aid societies where they came together, and there was a forerunner of life insurance and disability, pools of money to help people who were in need of help financially when there was a catastrophic event. It's a genius financial instrument, and when used effectively, it helps to make sure that people, as they go through their life cycle, will achieve their financial goals and objectives. We do something I often call it the financial roadmap with clients. And we'll talk about what's important about money to them, right? And what do they say to me? Saving taxes, getting better investment returns, and increasing cash flow. That's not what they say to me. They say to me, I want to create a legacy. I want peace of mind. I want financial security. I want to have adventure, right? And the ability to achieve those things is compromised if you do not deal with the natural risks that come along through our life cycle. And all insurance is designed to do is to deal with those risks, pure and simple. Very cost effectively, very elegantly. Okay, let's keep going on to our presentation. And the first risk that I'm going to talk about, and then I'm going to bring Brad up. Brad, I'm sorry, I'm monopolizing your time here. Is we're going to talk about mortgage insurance. And the only reason, as I scan the room here, I'm going to keep this very quick because most of you probably don't have a need for mortgage insurance, but your kids might. So if you're carrying debt right now where you have insurance, and particularly if you know of folks that have insurance, particularly bank insurance that's covering mortgage loans is the typical one that I think about. The default option is just let's sign the paperwork with the bank and get that mortgage looked after, right? Through life insurance, something happens to me, it's paid for. But that may not necessarily be the right option to choose. And so I'll cover off some of the myths around mortgage insurance, okay? So again, for many of you this is not relevant. But when you get the video and you get the information after the fact, you have lots of people around you that just by default buy that mortgage life insurance to their bank. It's just an automatic default. And in fact, the bank sometimes even implies that they got to do it. The bank just wants to know that there's insurance in place. It doesn't necessarily have to be with them. So what are some reasons why we may not default to the traditional mortgage insurance that our financial institution might offer? Well, one of the things which is interesting is when you take out mortgage insurance, let's say I need a $200,000, I've got a $300,000 home, I've got a $200,000 mortgage, and I buy some mortgage insurance at $200,000 policy, it's basically kind of decreasing term. So what's the mortgage balance? $200,000. The original premium is underwritten based on $200,000 of insurance to cover that mortgage off. What typically happens to mortgages over time? They drop. Okay, so the need for insurance will typically decline, but what happens is you've got a declining balance for the mortgage, but a constant rate of premium, right? So what happens is you're underwriting that cost of insurance at that rate to cover the mortgage over its life. It's not necessarily a very cost-effective way of doing it. So regardless of what your original mortgage was, the bank bases the cost on the initial amount of the mortgage, yet you pay down that outstanding balance. So that's one issue that sometimes comes up. Another issue, and Brad could probably add some insights to this, sometimes with these kinds of coverages, we think that when we make the application, we sign off on the form, there's 3 or 4 or 10 different questions, but really those questions, you're not getting approved for insurance necessarily. All you're doing is you're satisfying a pre-screening process. And what can happen is when there's actual a death claim, there can be underwriting happening at that time. Isn't that right, Brad? Right, so people think that, oh, I've got my mortgage insurance, I've gone through the application form, I've checked off all the boxes appropriately, now I've got my coverage. No, what you have is you've qualified pre-screening. Then when there is a death, if the death happens, then the formal underwriting takes place at that point in time. And there's a lack of there's ambiguity there, there's a lack of clarity in terms of what you actually have. It seems to me that when you buy life insurance, you want to guarantee that you have life insurance. You want no ambiguity. All you want are guarantees contractually, okay? So people need to really look at the fine print when they take out the coverage. Mortgage insurance secured from the bank is less expensive than owning it personally. That's probably the most common comment that I get. And I'll give you a very quick example. You may want to write this one down. It's not on the slide. So we pulled an example of a 45-year-old male with $250,000 of mortgage insurance. And this happened to be, I won't name the bank, so I'll protect the innocent. This individual for $250,000 of mortgage insurance was going to pay $72.50 per month, what in essence was a decreasing term insurance. So what we did is we looked at some insurance that Canada Life was underwriting, a 20-year term policy, because we thought the loan would be gone within a 20-year period for sure. And that cost was $55.80. But the big difference is, for $55.80, the client always had the $250,000 of insurance, never declined. For the $72.50, the client had $250 declining over time. At the end of that term, when the mortgage was paid off, there was no insurance, whereas the other individual always had that insurance. If they wanted to keep carrying it, they could. There'd be conversion options to do that. So that's an introduction to the world of insurance planning. The reason I use this example is that it is a great example of the devil's in the details. And as Brad begins to talk to you about insurance planning, it's really critical you understand what coverages you have in place right now. All of you likely have insurance portfolios. But when was the last time you really dug into the contracts to completely understand what you have? Right? Most people are very, like I said, cavalier. They think they've got something in place when maybe they don't. So when we talk about review meetings and giving you feedback after the discussion today, that's my challenge to you. Make sure you understand. You don't have to meet with me to go through that, but if you want to have a consultation, I tap into experts like Brad to bring that expertise to the table. Okay, so it's a real pleasure for me to have Brad present today. We've collaborated many times. Brad also works with, we have 30 advisors in the Asante and Taylor branch, and Brad plays a role in consulting with those advisors and their clients on insurance issues. So Brad, you've been in the industry for how long now?
26 years.
26 years. There's not a case or situation that Brad probably hasn't experienced, seen. So he comes with a depth and breadth of expertise in terms of this discussion. So please join with me in welcoming Brad Charlton. Brad?
Thanks, Sean. And it is my deepest pleasure to be in front of you clients of Sean. My favorite part about doing my job is having an opportunity to talk to the people that actually use these tools to improve their situations. I have a kind of a funny slide up here first. I don't really want to minimize what wealth planning is, but I think the reality of it is this is pile it up, spend it, and what you can't spend, give away. And who you give it away to is where I come into play, and how you give it away. So that's kind of the estate planning side of where life insurance can come into play. And also when we talk a little bit later on in the presentation about something like critical illness, long-term care, and our brief discussion on travel insurance. There's been a huge change in our industry in terms of perception, and I've done a presentation for some of our advisors at Asante called "This is Not Your Father's Insurance." We've migrated this whole idea of risk planning from the days back when I first started, and maybe before that, which probably lended itself to some of what Sean alluded to in terms of the stature that we have. And I'm sure everybody in the room here has seen or heard of the movie Groundhog Day with Bill Murray. Well, I'm Ned, the guy he meets every day who wants to sell him the single premium whole life policy. That's what we've been working against in terms of a stereotype for a long time. We believe in our industry that we've broken through that stereotype, and we start talking about safe money. And when you're in that stage, and I can see by the crowd that a lot of us are in that stage where we've accumulated some money, we're at that point now where we're managing it and or spending it. So we typically take an attitude that some of that money has to be safely invested. one of the things that people are completely unaware of is the ability to use a permanent form of insurance as a safe money investment. And what we do is we start to help individuals understand that life insurance is an asset class. It's not a liability class anymore. Just like a bond, just like your investments, just like a stock, it's a different class of investments. And we can actually formulate an internal rate of return on this tool that you can use in your risk planning. And we do that quite often when we do our estate planning modules, is we talk about using insurance as an asset class. It falls on the asset class scale. I'm not sure if you're familiar with the term called standard deviation. That's a term that's used in the investment industry to rate risk. The lower the standard deviation, the lower the risk. These types of programs actually fall below, on the risk scale, below the 5-year Government of Canada bond. So if you can imagine how safe people consider 5-year Government of Canada bonds or 5-year GICs in terms of safe investments, some of these programs that we move the clients into have a lower risk than a bond, a GIC, or a Government of Canada bond. So we talk to the advisors who talk to their clients about looking at this as another form of investment. Sean did a really good job of talking about our ability to get up every day and go to work and what happens as we pass through our life, and we've been fortunate enough to achieve a modest amount of success. The comment about most of us weren't born into that. Most of us don't have the last name of Eaton or Greenshields or any of those Richardson, last name of Richardson and things like that. Most of us have gotten up every day, gone to work, invested the difference between what we needed to spend on our families, and we've made a great deal of, or had a great deal of success getting to that point. When we're young, obviously it's the ability to get up every day and go to work that is very important to indemnify. That's called the human capital side. But interestingly enough, as we get older, and mainly because our timelines to work shorten up, the importance of the human capital will start to decrease. While we're decreasing the human capital side, the wealth capital or financial capital side of the equation becomes more important. How many people in this room would go without homeowners insurance? None of us. Why? Well, probably because many of us are at the stage right now where it would be impossible to replace that home. We're not working as much anymore, we're not working at all anymore, or we may be in that life cycle stage, 55 and over, where we don't have enough time to earn enough money to replace that lost asset. We're willing to spend the rest of our lives while we're living in our home protecting that home asset, but yet we don't protect the more important asset, which is our capital. All the money we've built to that point in time, because once we get to that area where we're spending it, we don't have the inclination or the time to replace that money that could be lost to a varying degree of risk elements. Taxes, long-term care, any of those things that could take a big chunk out of what we've accumulated over our lifespan. As an example, another question where you don't have to raise your hands, just as Sean has said, but how many people in the room think that over the course of your working lives, you haven't given the government enough tax? There's always one guy that says, I need to pay more. They rarely show up at our meetings, but there's always people that feel that way. Now think about that over your lifetime. And I don't want to depress anyone, but think about how much you've paid the government in all the varying forms of income tax, sales tax, this tax, and that tax. And are you at a point now where you could very well say, I think I've had enough? I think I've done enough. I don't really need for the Government of Canada to get any more of the money that I've earned. But yet, we still see clients all the time fail to see the value of indemnifying that risk, the task risk. As Sean mentioned about the cottage property, a lot of individuals don't recognize that because it's not their principal residence, capital gains apply. Now, capital gains is not a really bad tax as far as taxes go, but can be significant. $1 million property, as a rule of thumb, would require the family of that property that inherited that property to pay about $250,000 of tax. That's a lot of money. And when families haven't retained enough assets to pay the tax, that's where we run into a problem. And that's where indemnifying those issues by protecting your financial capital. And financial capital as well, most people think of investments, but it could be the favorite family cottage, or it could be something else that's very important, like a business. I use the term dormant assets, repositioning assets all the time, because if you remember my little funny slide at the beginning, pile it up, spend it, give it away. We actually don't know how much will be left when you give it away. Could be $1, could be $100,000, could be $1 million. Problem is we can't figure that out because we're not there yet. We can approximate things based on spending habits, based on rates of return, but we just can't give you a finite number. We also know that if you've had Sean as your advisor, you'll probably be in a point at when that time happens that there will be something left over. There'll be assets that you could never really spend. You have a spending pattern, we have a very, very reasonable rate of return. We get to that point when you and your spouse have passed away, there's a certain pool of assets that we know will be there. And these are the assets that we want to address in terms of helping out with this legacy issue of what we can pass down to the next generation. And we're going to use a contract called the participating whole life, which moves our paradigm from insurance being a liability and a cost to insurance being an asset in your portfolio, because it has a liquid-based asset position, not only at the time of the passing of the family, but also it shows up in your balance sheet, it shows up in your financial report as an asset on the books. We're going to use some presumptions here. We're using a fairly high fixed income number. Or does anybody in the room here think we could get 5% in a GIC today? No. In fact, when I did this presentation with a group of advisors like Sean, I challenged them to tell me what the best GIC rate would be for 5-year money. And I was shocked that they actually didn't know. It's down now below 2% for 5-year money. That's very low. So we're going to compare something towards an alternative investment that we can't achieve today, but yet it's a nice comparison because the example we're going to show it actually still looks as attractive as it did a number of years ago, and we're presenting it against a 5-year safe money alternative. So as an example, you really don't have to look too much at anything under the bottom number. If we had those assets that were sitting in your portfolio that you knew you'd never spend, in this particular example, at the time of death, which would be life expectancy for this couple, there would be about $800,000 that would go to the next generation. That could be used for anything, including paying any taxes that were owed. In our example on the right, using our alternative asset class, we end up producing about $1.6 million of legacy benefit to the next generation. Now think of that really importantly here. This is, if I use this extra money that I know I'm not going to spend and put it in a 5% GIC, my family gets $800,000 if we die on time. If I move the money over here and put it into this alternative asset class that Brad mentioned at the presentation, that same repositioned dollar will generate $1.6 million of legacy planning if the individuals pass away on time at life expectancy. If the individuals have a misfortune and die well before the life expectancy tables, the amount of money that the fixed income investment would have grown to would be significantly less than my example. So if we were to calculate the internal rate of return of this presentation, The earlier we have the unfortunate event, the higher the rate of return that our solution provides. The other thing to remember is I mentioned that this is an asset repositioning strategy. So in our example, we're using $30,000. It's not being spent. And this is the thing that we try to help the clients understand, because this is a paradigm that people have gained from what they remember their parents' insurance planning being, which is this is a cost. This is gone money. I've spent the $30,000 and I'll never see it again. This isn't what we're talking about. This is talking about repositioning those assets. They sit on your balance sheet, and you can actually stay close to your repositioned money. And in this example, you'll see that right around year 7 or 8, our solution that helps improve the legacy positioning of your estate planning actually has a balance sheet position almost equal to what you've moved over in terms of a cash surrender value. It's liquidatable to you at any time. So it is a liquid investment. You have access to it if you need it. If you don't need it, it stays in place until you pass away. Ultimately, you can see that over a 20-year period of time, you've repositioned approximately $600,000, and I can't read that far one. And it's showing that the value of this contract that you could actually use for emergencies, if you felt you needed to give your grandchildren $10,000, $20,000, $30,000 each, some living benefits, some living legacy pieces, you could use this alternative asset class to satisfy those important issues at that time. Holding this till the time you pass away obviously creates the greatest legacy, but because this is an asset and not a liability, and you have access to it, it also provides some ancillary benefits to you and your family. So that's the piece that we're going to talk about as using insurance. And again, I think you may recognize that I haven't talked about insurance needs. I've talked about using insurance. Because in estate planning, the purpose of estate planning is to organize everything that you've got, everything that it's taken you a lifetime to put together, to organize those things so that the outcome to your family is better than if you did no planning. I think you'd all agree that that's the definition of estate planning. Here's what I've got. Can we reorganize it so that the outcome at the other end is better than if I did nothing? That's what Sean and I are challenged with every time we look at a file. If we can't improve the outcome, then we don't make any changes. But we use these products to improve the estate benefit. I always say to my advisors, you don't need a will. And they cover their ears. No, we don't want to hear that. You don't need a will, you don't need a trust, you don't need financial planning. You can use a will, you can use a trust, you can use financial planning, and you can use insurance, because by doing so, you improve the end result of what it's taken you a lifetime to put together. So on that note, I'm going to move to an area that Sean and I want to talk about, which is travel insurance. Because here's a thing that can be one of those events that can mitigate all your years of hard work. And I think everybody's heard the horror stories. I mean, the most recent one was the $1 million baby in Saskatchewan. I don't know if you've heard that situation, but again, it's an example of what can go terribly wrong. Now, caveat my comment that this doesn't happen every day, but certainly there are travel insurance claims that are not paid. That one was fairly onerous. But again, the actual reason for it not being paid was quite valid. And misinformation given to the traveling couple when they wanted to go on their holiday with a wife that was severely pregnant. So the first thing that we should talk about is the fact that there are a lot of people that I know, even some of our advisors at Asante, that rely entirely for their travel insurance on their credit cards. When Sean talked about reading the fine print, that's the problem, is the fine print on these cards is too fine, and all of us at our age, we can't even read it with the best reading glasses. But I'll give you a couple of ideas about what they don't pay. How many people who have a credit card have seen that their credit card has travel insurance on it? What do you pay for it? What's the premium for that travel insurance? It's free. Anybody ever heard the term, you get what you pay for? It's not underwritten, and you're not paying for it. So there's some things in there that you have to be careful with. One of them, I'll talk about it in a slide, is the stability clause. But there are things in there like excluding for sports. And people think sports, well, rock climbing, jumping off a cliff in Acapulco. You could be playing beach volleyball, break your arm, and find out after you've paid for the ambulance and the emergency room that when you get home, you weren't covered because you were playing beach volleyball. Sports exclusions, all these pre-existing exclusions, things like stability, which I'll get into in a second. And in terms of the maximum amount of days that you can stay. Can you use your credit card for travel insurance? Yes, but I would not use it at all if I was worried about not being paid. When we talk about stability, and this is incredible how people have ignored this in the travel insurance, and this typically is most of the reason why claims are denied. Most of us are traveling when we've earned enough money and saved enough to have that as an asset that we can tap into, so that we can travel down to the States, travel down to some warm climate. But now that we're a little bit older, we may have a few things wrong with us. We might have high blood pressure, we might have cholesterol issues, we might have had a couple of scary medical events. Stability means, and it's different for every carrier, how long does your condition have to have been stable so that if you have a claim that's related to that condition, they will cover you. People typically think of things like heart attacks, cancer, but high blood pressure. Well, I'm stable. In fact, I'm so stable that my doctor lowered my medication last week. Guess what? You are now not stable because you've had a change in medication. There's only 2 medications that you can be taking regularly where the stability issue is not a factor. One is insulin. And can anyone guess what the second one is? Because I had no idea. Ever heard of warfarin? I'm suspecting because some of us have had to take it. Warfarin is the only other medication that stability is not an issue, because if you've ever been on warfarin, you know that that thing it goes up and down crazy amounts depending on certain, what you ate that day or whatever. So your stability in warfarin is not an issue. Your stability with insulin is not an issue. Everything else is you have to be stable, whether it's blood pressure medication, Lipitor, heart attack, cancer, all these sorts of things. Now, remember that the stability is only related to that particular issue and whether that issue would have caused you an episode while you're on holidays. If you have a heart problem and you go down to the States and break your arm, unless you broke your arm because you passed out because of the heart condition. Now, we all laughed about that, but guess what? That's what they look for. That's what they look for. Did you have an episode? But getting away from that, if you broke your arm or if you were in a car accident or whatever, and you would probably be covered. But that's why the best coverages, and Sean's going to talk about something that you can do that eliminates a lot of this stuff. The best coverage is stuff that you're underwritten for, that you have to pay for, and that the exclusions and stability clauses are more reasonable. So protect your investment when you're going on holidays, because I don't know a lot of us that can afford to take a $100,000 dip in our savings because we didn't get the proper protection traveling abroad anywhere. Some of the, and again, you get what you pay for. Some of these plans offer really remarkable services. And the only reason I put this slide up here is because I use this. when I was on a holiday in Hawaii. It was the coverage was with this carrier I was using. I had an episode of some back pain. I didn't have a clue what it was, but it hurt like heck. Phone this number. They had a doctor phone me in 5 minutes, literally 5 minutes, asked me my symptoms, asked me if they wanted me to come to my hotel room. And I said no. I'm a guy. I don't need you to come see me. So she did an analysis on the phone. She said, I have some good news and some bad news. The good news is I don't think it's anything too serious, but the bad news is you have to go to the hospital. Would you like us to call you an ambulance? Would you like us to do this? Would you like us to do that? I got to the hospital. They knew I was coming. Whew, off. I was in and out of the emergency room in an hour and 45 minutes with an MRI, with a full battery of blood tests, and with a diagnosis of a kidney stone. 1 hour, 45 minutes, $7,000 bill, not counting what it cost for this, all taken care of. That's what I paid for. 24/7. I will never travel unless I have proper travel insurance, because I thought I was never have an issue. I mean, even at my age, and I've traveled a lot outside of Canada, I've always thought it's the other guy that needs to use this stuff. I'm going to pass it back to Sean. So thank you very much, and you get to see me talk one more time.
Great, thank you, Brad. So our journey's taken us so far where? I talked at the beginning around sort of that life cycle continuum. We want to protect our earning power. Eventually we want to protect our assets. That's part of what Brad was talking about. Again, if you know of people that have mortgages, that have mortgage insurance, make sure they're aware of what we talked about there. So that's one aspect of insurance planning. Brad talked about insurance as an asset class. We don't normally think of insurance as an asset class, but actually if you have assets that are, I won't call it redundant capital, but capital that you may in fact outlive, you can use insurance planning, repositioning on your balance sheet to create more legacy value and get some tax effective growth in your portfolio, and to get very competitive yields compared to what you get on GICs or government bonds. And then we talk about travel insurance. So what I want to talk about with travel insurance is it's sort of part of our wheelhouse. So when I talk to clients about insurance planning, it really is to try to put guarantees in place. So we talked about the issue around whether it's mortgage insurance, travel health insurance. You just want to make sure that when you have a claim, when you have a need for the insurance to be paid out, that you have rock solid guarantees that in that moment the policy will honor its commitment to you. And normally there's some clues around that. It's generally going to be a policy you've actually submitted an application for. You probably had to pee in a bottle. You probably had to answer a lot of health questions. Probably the insurance company talked to your doctor. There's been strenuous underwriting. And why do you think that there'd be so much strenuous research on your health before they underwrite that contract for you? Absolutely. They're quantifying the risk because they know once they put their name, the insurance company's name, to that contract, they are contractually paid out as long as you keep making those premium payments. So they're ruthless when it comes to the underwriting piece. But once you're through that, you know you've got something that's actually worth paying for. You'll get those contractual guarantees. Interesting enough, travel health insurance can be a little bit of a quagmire. But I want to talk about something called Travel 80. It's a product that, as a practice, we don't get involved directly in travel health insurance typically. I think there's too much liability risk, quite frankly. I don't want to be the person making recommendations to clients on travel health coverage. It really is a landmine. But this is one product that we've gotten involved in because it acts just like a traditional life insurance policy or disability contract in the sense that you have to actually apply for it and be approved for it. And once you have it, it can't be taken away from you, at least until you're age 80. So here's a scenario for you. Do you have property in the states you go to? Do you enjoy traveling outside of Canada on a regular basis? Is that part of something you want to be doing long term in your retirement years? And if you said yes to those things and you want to make sure that that is something that's part of your ongoing lifestyle, what is one of the issues that could get in the way of that? Obviously health. So always the issue is with health, travel, and coverage is that are you routinely having to reply every time you go get that coverage? Very often you have to. Like it's not like you have this coverage for life, no matter what your insurability is. So that creates an issue, right? If I've got property in the States I like to go to, and either if I have a spouse, what if my spouse loses their insurability, can't get adequate coverage to go down south? I can get it, but at the end of the day, how happy will my wife Tanya be as I kind of go off for 2 or 3 months? See you, honey. I'm going to enjoy the place down in Mesa, right? Not a great deal. So Travel 80 has really been designed to cover off for those people who have built lifestyle and traveling, right, abroad. That's part of their long-term plan. And they want to make sure that declining health or health problems or issues don't get in the way of that planning. That's really what this product has been designed to do. So if we just cover off the main components, I'm not going to spend too much time on this. There is some information in your handout. So it's more just FYI, and those of you who want to talk about it further, just let me know in the feedback form and we can have a conversation on it. So the first thing to be aware of with Travel 80 is it's guaranteed renewable. In other words, it renews every single year. You can be underwritten, you can see further down, you can be underwritten for the travel coverage between the ages of 18 and 65. So there's a window. Unfortunately, if you're past age 65, it's not a product you can consider. But between the ages of 18 and 65, you can apply for the product. And there's no need to reapply every year. So if I'm a 45-year-old and travel's a big part of my schedule, or a 55-year-old or a 60-year-old even, I know that I can apply for this coverage. If I'm accepted, I'll have that coverage right to my 80th year. And the premiums never change. So if I apply for the coverage, if I'm accepted for the coverage, the insurance company's not going to come back and increase the coverage rate just because I've gotten older. And if I have declining health, if I have health issues after the product's been underwritten, they cannot take that policy away from me. So it's a perfect product for those people who want to protect their insurability and their ability to have travel health coverage if they want to do that ongoing and protect against that declining health that can sometimes happen. 30-day multi-trip plans, so you can basically be traveling constantly. There's no deductibles. What's very interesting about the plan, and we had a few clients, they really kind of latched onto this. It's not like the repositioning of the asset class discussion that Brad talked about. But there's a return to 50% of all premiums paid if you're claim-free for a 10-year period. So there is a rate card for Travel 80, I think, in the package, right? So you'll see what the rates are for each year from 18 to 65. And if you pay for a number of years, you never have a claim, right, on that contract, you'll get 50% of the premiums to be paid back to you. So it's a very interesting product. It's not for everyone, but we've had clients who are specifically traveling, real estate outside of the country. That's just part of who they are. And they never want to lose that opportunity to travel around the world and do those things, or just go to the States periodically. Okay? Okay, Brad, you're up.
Just to add on to what Sean said about the power of the Travel 80. So that means that if you have Travel 80 and you have an unfortunate change in your health, cancer, heart attack, any of these issues that could make travel in the States very risky, they can't take it away from you. The only thing is that you have to qualify for the stability issue. So again, you look into the contract that says if your heart attack you've recovered from it and you are stable, which is usually about a 30-day to 60 to 90-day scenario. After that point in time, even though you've had a heart attack, they can't take the coverage away and you can go travel, even if you have a second heart attack or a subsequent issue related to the heart attack. Later on, they would still have to issue the coverage and you would have to get the redemption of the medical expenses. It's a very powerful tool. Quickly through this, because we're doing a presentation later on in the year with a group of a panel that I'm, again, very fortunate to be a part of. This is another area of things that can knock the stuffing out of all of your years of accumulation, which is a long-term care event. And there's a difference between long-term care and acute care. We do acute care very well in Canada. So while some would disagree with that statement, but I would say yes, we generally do acute care very well. But the long-term care issue is not going very well for all of us. I heard a statistic yesterday at a presentation I was at that scared the heck out of me. And that is that 85% of us will have a long-term care event. 85% of us. Why? because our healthcare system is doing such a darn good job of keeping us alive. What used to end our lives isn't anymore, but the chronic health issues that come with that have pushed us into this realm. My father's 86 years old, still drives, still lives on his own. He is the exception, not the rule. So we need to be aware of this, we need to plan for it. Won't get into this legislation issue because we'll be talking more about this at the event, but please, please do not think that the government will take care of you. I know we like to rely on our governments a lot, and we do have this sense that we live in a more socialistic environment in Canada than other areas of the world, and we do. And they do try to do the best they can, but they are overwhelmed. So we have to be aware that there may be things that will not be available to us. And again, when we get to that point in time where we're at that decision-making crossroads, what type of home care do we want? What type of assisted living care do we want? What type of a facility do we want to be a part of? Unfortunately, the old rule comes into play, and cash is king. If you have money, you have choice. You can indemnify that, or you can use your own money. I prefer to indemnify it because I'd rather use other people's money. But that is the long-term care picture as we go forward over the next 25 and 30 years. Some of the statistics are sobering. They're very sobering because nobody gets a free pass anymore. You pay something. There are formulas and tables that are used. Every province is different. But you pay something. And the impact that will have on all the assets that you've taken your entire life to build up will be significant. As an example, if someone had to spend $4,000 a month on a facility and they lived for 5 years, they would burn through $250,000. So if we reach that point in time where we retire and we've got our $1 million, there's an 85% chance, and I know how long the average length of stay is in a facility, there is a chance that somewhere in the neighborhood of $250,000 will be spent on long-term care for one of the couple. We tend to think that, well, there's caregivers that can help out. And yes, that does happen. But the toll on the caregiver can be almost as devastating as the toll on the person who is affected by the loss of independence. Just a couple of examples. You can read through those quickly. They are sobering. And we're not talking about, in some of these examples, people in their 80s. This is a young mother. This is the care. Monthly cost, $2,500 a month. At her age, you can do the math, how much it's going to cost for the rest of her life. 83-year-old female, north of $4,000. And unfortunately, this is going to sound crass, but an 83-year-old female probably will stay 4 or 5 years in a home. And there's your $250,000. This is the lucky one. My mother-in-law, COPD, in a hospital for 4 months waiting for a room. By the time she got into a home, she'd given up. $3,000 a month in this home, and it was not a fun place. She died 4 weeks after we put her in the home. She gave up. It was horrible. She'd spent 4 months in a hospital and then moved over to the home. So she was one of the lucky ones. Now, she wasn't the lucky one. We were the lucky one because we didn't have to spend her entire fortune keeping her in that home for 5, 6, 7, 8, 9 years. Long-term care insurance is available to Canadians. And again, this is where Sean talked about some of the aspects of risk planning. you can indemnify this risk. You can actually buy a product that will pay to you an amount of money that you can use with your own discretion as long as you suffer the inability to do two of the activities of daily living. This gal that did a presentation yesterday said it perfectly. When people don't know what the activities of daily living are, what did you do in the first 45 minutes of getting up today? You got out of bed. You went to the bathroom. You showered or washed up. You got dressed and you had breakfast. Well, there's 5 right there. There's one more which has to do with cognitive abilities. But if you can't do 2 of those, you qualify for the benefit. Here's my comment about the portfolio. If all you knew you were going to have left in your portfolio was $250,000, would you rather give it to your family or give it again to the care home? I know where my allegiances lie, and we can indemnify that. The other nice thing about this is for individuals that are a little bit further along the path where the cost may be prohibitive to getting this product. I've talked to Sean about this as an idea. If you think that you might have to spend $100,000 in home care and you're at an age where the cost is too restrictive, then buy life insurance. What does life insurance do? Pays when your heart stops beating. If you think you're going to spend $100,000 in home care, buy $100,000 of insurance and do sort of a back-to-back. Be comfortable to know that you can spend your money, because when you pass away, the insurance industry, the insurance company is going to backfill that amount into your portfolio so that your family can have their legacy. That's the end of my presentation. I think we move on to the last piece, which Sean is going to handle.
On that happy note. Okay, so it's really important information, and Brad alluded to the fact that we are doing this branch event next month on long-term care. And Brad's one of the speakers, Norma Kirkby with the Alzheimer's Society of Manitoba, and Lynn Feynman, who's been working in the long-term care space for ages, will be our panel members. I have the real pleasure of being the moderator for the discussion. But one of the things I said to the panel members, I said, listen, this is a heavy topic. It's very difficult to take that topic of long-term care and spin a positive message around it. And yet it's a really important one to have a discussion. If you have a partner, you have family, it's actually a really important thing to unpack. And so I said to the panel members, we just need to educate and give people information, and then also give them some hope that there are some solutions or ideas. You know, whether it's indemnifying, as Brad says, insurance programs, whether it's self-funding by spending down assets you built up. It's just one of those conversations that the more you get on the table and just talk as a family, the less anxiety there is around it, right? And that's the positive message around that whole topic. So hopefully, if it works for your calendar, you can come out to that event. It's going to be, I think, a really good event. So we talk about gap analysis. I've talked about this before the last 2 sessions. For those of you who have been prompted to go, maybe I should sit down with Sean and kind of review things, we provide the gap analysis, and really all that is just what's your current situation. This gap analysis could be looked at for retirement planning, investment planning, insurance, risk management. And the process, if you're a client, you already know what this process is. If you're a guest, you may not know. Step 1 is we just have a coffee chat, talk about your situation, maybe identify there's potential planning opportunities. And if the conversation goes reasonably well, then you make a decision about whether you want to continue the discussions. We gather some financial information. We begin to do a certain amount of analysis for you. We prepare specific forecasts and recommendations for your review. And then we take a look at the information, make adjustments, answer your questions, and develop an implementation strategy for you. So for those of you who want to revisit the gap analysis as a client, or you're a guest and you'd like to talk to us about it, we'd be pleased to do that. And you can let us know that in the feedback form that's in your package. Well, it's my hope that you enjoyed this edition of our Lunch and Learn video presentation. If you're on our website viewing this presentation, you will find some additional show notes that will provide links to other helpful resources around the whole area of insurance planning and risk management. If you'd like to connect with our office and talk further about these concepts or have questions, don't hesitate to do so. Again, if you go to our website, www.seanhumphreys.com, we'll have lots of helpful resources and previous videos from Lunch and Learns that we've hosted over the last few months. And we can be reached at 204-977-8049, and the email address is shumphreys@asante.com. All the best with your wealth planning journey.